Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Thanks for having me. I'm really looking forward to getting into this one.
Yeah, me too. So today we have a mission for this deep dive that honestly feels a bit like a financial thriller, but it's happening right now in the real world. We are demystifying a massive, largely hidden corner of the global financial system. It's called private credit.
Right. And I know that sounds like pure Wall Street jargon, but it is incredibly relevant to anyone listening right now who has a retirement account.
Exactly. And here is the real hook for you, the listener. According to recent analysis we've been reviewing, there is a financial tripwire out there right now that many experts are calling a far bigger economic risk than the ongoing geopolitical conflicts. Yes, even including the Iran war.
Which is a bold statement, considering how much airtime the geopolitics gets.
Right. I mean, think about that for a second. We hear about geopolitics on the news every single night, but we almost never hear about private credit.
Almost never.
But by the end of this deep dive, you are going to understand exactly why your 401k might be tied to this hidden $2 trillion market.
Yeah.
So to help us unpack this, we've got the perfect expert here to give us the calm, big picture context.
I'll certainly do my best. $2 trillion is a massive amount of capital, and it's operating largely out of the public eye. So to really understand the gravity of the data we're looking at, we have to understand how we actually got here.
So take us back. How did this $2 trillion machine actually get built?
Well, it really traces back to the aftermath of the 2008 financial crisis. After 2008, traditional banks faced incredibly strict new regulations. Lawmakers essentially stepped in and said, you cannot take these wild risks with everyday depositors' money anymore.
Which makes sense, right?
Of course. So banks dramatically pulled back on lending to smaller or riskier businesses. But the thing is, those businesses still needed money to operate, to grow, and just to survive.
Nature abhors a vacuum, especially in finance.
Exactly. So private funds stepped in to fill it. These are non-bank entities, large investment firms, alternative asset managers, and they started lending money directly to businesses. This is what we call private credit.
Okay, so they became the new lenders.
Yes, and looking at the data, this market hasn't just grown. It has absolutely skyrocketed. Current projections show it hitting roughly $2 trillion by early 2026.
$2 trillion. Okay, let's unpack this for you, the listener, because the sheer scale is really hard to wrap your hair around.
It is.
The central issue here, and the reason experts are starting to sweat, is something called the valuation problem. Let's use an everyday analogy to explain this. Think of public stocks, like Apple or Microsoft.
Right, the ones everyone knows.
Exactly. Checking those stocks is like checking the weather app on your phone. You want to know the temperature. You open the app and you know instantly to the exact decimal point what it is right this second.
Because it updates constantly.
Yes, and that is called mark-to-market. Public markets tell you exactly what an asset is worth every millisecond of the trading day.
But private credit is completely different.
Right. Private credit is more like guessing the value of your house. You might look at your neighborhood, look at a few recent sales, and say, well, my house is worth $500,000.
But you don't actually know for sure.
You won't truly know what that house is worth until you actually put it on the market, find a buyer, and someone actually hands you a check. Until then, it's just an educated guess on a piece of paper.
And that educated guess creates a phenomenon that analysts at DoubleLine recently called volatility laundering.
Volatility laundering?
Yeah.
That sounds a little sketchy.
It's a fascinating and honestly somewhat terrifying concept. In finance, investors look at risk metrics, like the Sharpe ratio, to figure out how much risk they're taking for a certain amount of return.
Right, the risk-reward balance.
Exactly. But because private loans aren't priced every day like public stocks, their prices never seem to bounce around. If you look at a chart, they look like a perfectly smooth, upward-sloping line.
Which makes them look artificially safe.
Yeah.
If you don't measure the volatility every day, it looks like there isn't any volatility at all.
Exactly. What's fascinating here is that the lack of daily pricing just hides the true risk. But the data shows the cracks are starting to appear in that smooth surface.
We are absolutely seeing this right now. According to recent research, a major player named Blue Owl recently had to freeze redemptions and sell off assets in one of their retail funds.
And Moody's, the credit rating agency, immediately flagged this as a liquidity stress signal.
Let's translate that from Wall Street speak to everyday terms for the listener. It's like going to your local bank branch to withdraw your paycheck, and the teller says, sorry, you can't withdraw your money today because we are busy searching the back room for cash.
That is a perfect way to put it. A liquidity stress signal means the firm doesn't have the actual cash on hand to pay out the people who want to leave.
Which is alarming.
Highly alarming. And when that happens in a supposedly stable fund, it forces us to look at what is fundamentally deteriorating beneath the surface.
Which brings us to one of the most surprising catalysts in this whole story. We are transitioning to our second segment here, and this is where it gets really interesting. The catalyst for this stress isn't just interest rates or inflation.
No, it's artificial intelligence.
AI. It always comes back to AI these days.
It really does. If we connect this to the bigger picture, AI is fundamentally shaking up the value of traditional software companies.
And why does that matter for private credit?
Because legacy software companies have historically been massive borrowers in the private credit market.
Based on the data, these traditional software businesses are getting severely squeezed. AI startups are coming in and doing things cheaper, faster, and more efficiently.
Which means the old software companies are losing their pricing power. Their profit margins are shrinking.
And when profit margins shrink, it becomes very, very hard to pay back those massive private loans.
Exactly. The statistics from February 2026 are alarming here. Morningstar DBRS released data showing that credit downgrades outpaced upgrades by an incredible ratio of 3.3 to 1.
3.3 to 1.
Wow. Yes. We are seeing a massive pileup of high-risk loans, specifically those rated CCC to C.
Which is right on the absolute edge of default.
Right. And the overall default rate has now hit 4%.
But I want to make sure we understand how this actually happens in practice, because it's not like a dramatic Hollywood bankruptcy where the doors just get padlocked overnight.
No, it is much slower than that. AI doesn't cause instant bankruptcies for these incumbent software firms. Instead, it slowly squeezes their margins.
It bleeds them out.
Exactly. It forces them to lower prices to compete, which means less cash coming in the door to service their debt.
So to explain how these companies survive on paper while essentially dying in reality, let's look at a concept called quiet restructuring. Let's use another analogy.
Good.
Imagine you have a friend who is struggling financially. They owe you a mortgage payment every single month. One month, your friend comes to you and says, "Hey, I don't have the cash right now."
A tough situation.
Right. But then your friend says, "What if I just write you an IOU and we add what I owe you this month to my total balance? I'll pay you later with extra interest." And you, wanting to be helpful, agree.
In the financial world, that IOU is called PIK, interest payment in kind. The borrower pays their interest with more debt rather than actual cash.
Right. And then the next month, your friend comes back and says, "Also, can we relax the rules a bit? I know I promised to show you my bank statements every month, but let's just skip that."
And you agree again. That's what Wall Street calls a covenant-lite loan. The lender gives up their protections.
And then finally, your friend says, "Can we also extend the final deadline for when I have to pay you back completely?"
And it looks completely okay on the lender spreadsheet.
Right, because the loan hasn't technically defaulted.
Exactly. The interest is technically still accruing, but the underlying financial health of the borrower is quietly, persistently deteriorating. The actual cash just isn't there.
That quiet deterioration is exactly what's happening to billions of dollars of private credit backed by these software companies. It's a quiet restructuring that hides the true pain.
But you can only hide the pain for so long. Eventually, reality forces its way in.
Which is exactly what we saw unfold in late February and early March of 2026.
Yes. This is where the theoretical risks suddenly became very, very real.
We entered what analysts are calling the Eve of 2008 pattern. 3 separate massive alarms went off simultaneously across the global financial system.
It was a chaotic few weeks.
Let's walk through these alarms because this is really the core of the immediate crisis. Alarm number 1, the accident.
The accident happened with the collapse of a UK real estate lender called MFS.
Now, MFS was a pretty significant player.
Very significant. And on paper, they looked totally solid. They had 1.16 billion British pounds in loans on their books.
Over £1 billion.
Yes. But when the company collapsed and went into administration, court documents revealed a terrifying truth. The true value of the collateral backing those loans wasn't 1.16 billion.
What was it?
It was only 230 million pounds.
230 million. That is a staggering gap. That is literally the difference between guessing your house is worth $1 million and finding out the hard way it's only worth 200,000.
It's a total wipeout of value.
And here's why this matters so much to you, the listener. It shatters the illusion that asset-backed lending is inherently safe. People thought, hey, even if the borrower defaults, we still have the real estate.
But the real estate wasn't worth anywhere near what the spreadsheets claimed.
Right. And this collapse didn't happen in a vacuum, did it?
Not at all. The contagion spread rapidly. See, MFS didn't just lend their own money. They borrowed from major global banks to fund their operations.
So when MFS went down,
It instantly exposed heavyweights like Barclays, Santander, Wells Fargo, and Jefferies. It sparked immediate fears of credit contagion.
contagion, the scariest word in finance.
Truly. It's where a failure in a private, non-bank lender burns the balance sheets of the traditional, highly regulated banking system.
Okay, so that's alarm one. The illusion of collateral value breaking down. Let's move to alarm number two, the redemptions. We just talked about Blue Owl earlier, but this one is even bigger.
Much bigger.
According to recent analysis from March 3rd, Blackstone's massive $82 billion fund, known as BCRE, hit a wall.
BCRE is an absolute giant in the private credit space. It is designed to be what they call semi-liquid.
Semi-liquid, meaning you can get your money out, but there's a catch.
Right, investors are told they can withdraw, but with restrictions. Usually, a fund like this limits redemptions to 5% of its total value in a given quarter.
Basically to prevent a bank run.
Exactly, it's a safety valve.
But the data shows that in the first quarter of 2026, redemption requests hit 7.9%. Investors were rushing for the exits much faster than the fund technically allowed.
And to manage the panic, Blackstone actually had to increase their redemption limit to 7%.
But even that wasn't enough, was it?
No, it wasn't enough to cover the flood of people wanting their cash.
Yeah.
They actually had to use $400 million of their own company and employee money to cover the shortfall and satisfy those investors.
400 million of their own cash. That is a huge red flag. It shows that semi-liquid is a great marketing term when the market is going up.
But it gets severely tested by reality when everyone wants to sell at the exact same time.
It's like a movie theater with 500 people inside and an exit door designed for only 20 people to use at once. When someone yells fire, that semi-liquid exit becomes entirely illiquid very, very fast.
That's exactly it. And that brings us to the third alarm, which acted as a massive accelerant to the first two.
Right. Alarm number 3. Geopolitics and spread spikes. This was an external macroeconomic shock.
Yes.
Looking at the recent reports, the escalating conflict in the Middle East, specifically the Iran war, sent a massive shockwave through the global markets. And to be clear, we are just looking at the market data here, completely impartial to the politics of the conflict itself. But the financial reaction was violent.
It absolutely was violent. European high-yield risk indicators, specifically an index known as the iTraxx crossover, spiked dramatically to 270 basis points.
270.
Yes, that is a massive jump in the perceived cost of risk. Investors instantly demanded much, much higher compensation to hold any risky debt.
And the most shocking fact from that week, according to the data, for one entire day, U.S. investment-grade new issuance was zero.
Zero.
A massive foundational pillar of the global financial system, highly rated companies issuing high-quality bonds to raise money just completely starved. The public market essentially froze in its tracks.
And when you synthesize these three events, a massive valuation gap in a UK lender, a rush for the exits at the world's largest private credit fund, and a total freeze in public corporate debt markets due to a geopolitical shock, Wall Street recognizes a familiar, very dangerous rhythm.
The Eve of 2008 pattern.
Right, small cracks appearing everywhere at once, hinting at deep structural damage below the surface.
So what does this all mean for the listener? We've talked about multi-billion-dollar funds, UK real estate, global banks. The natural question is, why should everyday people care about this?
It is a critical question.
Which brings us to segment 4, hidden leverage and the Main Street risk.
The answer to why everyday people should care lies entirely in interconnectedness. The financial system is a web.
Right.
We mentioned earlier that traditional banks pulled back from lending directly to risky businesses after 2008.
But they didn't actually stop interacting with the risk entirely, did they?
Not at all. Instead, traditional banks just lend billions of dollars to these private non-bank funds.
So the bank lends to the private fund, and the private fund lends to the risky software company. The bank is still fully exposed, they just added a middleman.
Precisely. And it gets even more complex than that. The Basel Committee, which is essentially the global watchdog for banking regulation, recently issued a severe warning about something called synthetic risk transfers, or SRTs.
Okay, let's break down SRTs, because that sounds like pure Wall Street jargon. What exactly is a synthetic risk transfer?
Think of an SRT as an insurance policy. A traditional bank has a bunch of loans on its books. To free up capital and meet regulatory requirements, the bank pays a private credit fund to take on the risk of those loans defaulting.
So the bank keeps the actual loans, but the private fund essentially sells them a guarantee.
Exactly.
So the bank thinks it is completely safe because it bought insurance from the private fund. But if the private fund is simultaneously getting hit by AI software defaults, the MFS real estate collapse, and Blackstone-style redemption runs, what happens to that insurance?
The insurance becomes completely worthless. If the private credit market freezes or collapses, the traditional banking system suddenly realizes it's holding all this risk without any safety net at all.
The whole system chokes.
Yeah.
And here's where it hits Main Street directly. Based on the data we are reviewing, there has been a massive shift in how retirement accounts are managed.
This is the crucial part for everyday investors.
During the current Trump administration, a White House executive order was signed in August 2025. This order significantly expanded the ability for everyday 401k retirement plans to access and invest in these alternative assets, which obviously includes private credit.
And just to analyze the structural impact of this policy neutrally, the intention behind the order was to democratize access to high-yielding investments that were previously only available to ultra-wealthy individuals and large institutions.
Right. The idea was to let regular retirement savers get in on the action.
Exactly. But it also exposes them to the exact liquidity traps we've been discussing today.
Former Goldman Sachs CEO Lloyd Blankfein recently issued a really stark warning about this exact dynamic.
He did. He pointed out that these alternative assets are fundamentally opaque.
Remember the house valuation analogy? You just don't know the real price until you sell.
Right. Blankfein warned that if a crisis hits and these private funds freeze redemptions, just like we saw with Blue Owl, and just like we saw testing Blackstone everyday retirement funds get trapped,
it's one thing when a billionaire can't get their money out of a hedge fund for 6 months. They'll be fine.
they have other liquidity.
Exactly. But it is a completely different universe of panic when millions of Americans log into their 401k portals and realize their life savings are frozen in illiquid private loans.
That is the ultimate Main Street risk. If 401k redemptions freeze, the situation moves rapidly from a simple financial loss on a spreadsheet to a full-blown systemic and social crisis.
It undermines basic confidence in the entire retirement system.
Yes, it does.
This is exactly why we wanted to do this deep dive today. We are looking at a $2 trillion market with questionable valuations, facing intense pressure from AI, flashing warning signs across the globe, and now newly tied to American retirement accounts.
It is a lot to digest.
It really is.
Yeah,
So let's pivot to the playbook. What are the actionable insights for you, the listener, as you try to navigate this environment?
Well, when global investors look at this landscape, they generally break it down into time frames. In the short term, looking at the next 1 to 3 months, the primary goal is risk mitigation.
So playing defense.
Entirely. It is about avoiding illiquid traps. If you have capital deployed in semi-liquid funds or alternative asset classes, you need to understand exactly what the redemption gates are.
Meaning, read the fine print. Know exactly how hard it is to get your money out before the rest of the crowd rushes the exit.
Exactly. And you also need to be watching public credit stress indicators.
Right, you mentioned that earlier. Because private credit is opaque, you have to watch the public markets for clues.
Yes. Keep an eye on indices like high-yield corporate bond spreads. If public markets are suddenly demanding way more interest to hold debt, you can guarantee the private markets are under severe hidden pressure.
Okay, so short term is defense. What about the midterm, say 6 to 18 months out?
In the midterm, we're going to see what the market calls price discovery.
Ah, price discovery. That's the reality check. That's MFS finding out their 1.16 billion pound portfolio is actually only worth 230 million.
Exactly. The forced selling will eventually reveal the true, bare-bones prices of these assets.
Yeah.
And when prices collapse, it creates massive opportunities.
For the right people.
Right. Institutional investors with unencumbered cash will be able to swoop in and buy these assets at steep discounts. However, this kind of distressed debt investing is highly complex and likely way too dangerous for retail investors to attempt directly.
Catching a falling knife is best left to the professionals wearing steel gloves.
Very well said.
But even if you are sitting there listening and think, well, I don't own any private credit directly, so I'm totally fine,
Well,
you still need to consider your indirect exposure.
this is a crucial point. Your portfolio might be exposed without you even realizing it.
Like bank stocks.
Yes. Do you own bank stocks? Remember, traditional banks are tied to this market through those synthetic risk transfers and direct lending to the funds.
And what about ETFs?
Same thing. Do you own broad market ETFs? Those ETFs hold shares of the giant alternative asset managers who run these private credit empires. If their funds face a crisis of confidence, their stock prices will absolutely plummet.
The web is completely interconnected. You just can't isolate one piece of the financial system anymore.
No, you really can't. And having that understanding is the single best defense an investor can have right now.
So, to summarize all the data and analysis we've explored today, the $2 trillion private credit market isn't a ticking time bomb that is going to violently explode all at once on a random Tuesday.
No, it is much more like a slow leak.
Right. It is a massive accumulation of hidden leverage, delayed valuations, and quiet restructurings that slowly, invisibly weaken the foundation.
And that weakened foundation becomes incredibly vulnerable to outside shocks.
Whether that shock is a massive shift in AI technology disrupting cash flows, a sudden geopolitical escalation freezing public markets, or simply a critical mass of investors asking for their money back at the exact same time.
It's all about what happens when the smooth, completely straight line on the graph finally meets the chaotic reality of the real world.
Which leaves us with a critical question to consider.
Yes, I'll leave you with this thought. In our endless search for safe and stable returns, have we accidentally engineered a financial system where the risks are just hidden from view until it's too late to get our money out?
That is a very provocative thought to mull over. And it's definitely something to keep in mind the next time you look at the seemingly perfectly stable returns in your retirement portfolio. Knowledge is your best asset, and we hope this deep dive gave you the tools to understand the invisible forces shaping the markets today. Don't forget to subscribe and hit that like button.